So a lot of what Dave spoke about there, he's led me in really, really nicely. And a lot of what I'm going to talk about is this idea about corruption. And when we talk about corruption, the term's kind of been abrogated so that people think it means money in envelopes. But what I'm talking about is the corruption, the impurities that we have now everywhere we look in the markets. There are no true price signals anymore. And Dave and I were talking about this earlier on. You know, we've both been in this business. Dave a little longer than me, but I'm pushing 30 years now. And at no point in those 30 years has it been easier to determine what's going to happen. But at the same time, it's never been harder to figure out when it's going to happen. And that's purely due to the corruption of these traditional price signals that guys like Dave and myself sit down and try and interpret in order to figure out what's going to happen in these markets. So I have a few slides for you. They're going to speak to that. And this is, it's a bit jumbled, but it's a really important slide here. So on the left of that red dotted line, there are 38 countries or regions in the world that currently have negative or zero real interest rates. And this is absolutely unprecedented. This has never happened before in the history of economics. And this is the main reason why people are struggling to figure out what to do with their money and where to get a return today. And it's a very deliberate ploy on behalf of these central banks to try and cure the debt ailments that they all currently struggle with. So you've got the entire G7 there with negative real rates. You've got the whole of the Eurozone ex Malta, which I think we can probably safely leave out. Apologies to any Maltese in the audience this evening. And the others there, these are also negative real rates. We've got quantitative easers. We've got 5 of the biggest central banks in the world all printing money out of thin air, which currently seems like a good idea, but I think we can all agree that you really can't print money out of thin air and expect it to last forever. And then on the right there is a list of countries that are still in the manipulation, the jawboning stage, the talking your currencies lower. But all these countries need negative real rates. They all need to try and force capital into places where it really shouldn't want to go. This slide is kind of terrifying to me. And this is what financial repression looks like. Just 5 years ago, tail end of 2007, if you had $10 million saved up, you could invest that in 2-year US Treasuries with essentially no risk whatsoever and get an income of $480,000 a year. And now that same investment will bring you in $24,000. That is financial repression. That one slide there is exactly what's happening. And this is a very, very deliberate strategy. Make no bones about it. That $480,000, or that $10 million rather, they can't have that sitting somewhere safely earning interest. They need that money in the economy. They need it invested. They need to get these economies growing. This is going to continue, and it's going to get worse if it possibly can. If they can find more ways to squeeze this lower, this is what they're going to try and do. Where are people going? Well, they're going all the places they shouldn't. You know, Dave is sitting there talking about how we think we can get 3%, 3.5%, and that's a good return when rates are negative. 3.5% is a very nice return. We've got people buying junk bonds here, as you can see. This is the Bank of America Merrill Lynch High Yield Master 2 Index, which is a benchmark junk bond index, and currently it yields less than 6% for junk bonds. And I think we can all agree that 6% for junk bonds is not really the world that many of us in this room are used to investing in. Another great symbol of what's going on here, this is the VIX. So this sense that the government have kind of got this all under control and they're going to keep everything stable for a long, long time. The VIX is it's an index that measures volatility. So you can see these big spikes here, but the big one in the middle there, that's 2008. And as you can see, it tends to subside fairly quickly. You can see further scares in 2010. There's one on the right there, 2011, that was Fukushima, the earthquake in Japan. And things tend to settle down. But the market, in terms of complacency and fear of risk, is back where it was in 2005, 2006. So when people say that it's almost like 2008 never happened, in terms of people's perception of the risk out there, it really hasn't. I mean, we are literally back to where we were when everything was great and the markets were going up forever. Meanwhile, despite the central banks trying to force you good people to put your monies into junk bonds and to chase yield in all kinds of bizarre places, 3/4 of their own reserves are held in gold bullion. And again, that's a very, very deliberate thing for them to do. You will never hear a central banker telling you that owning gold is a good thing to do, and yet in the West, say 3/4 of these countries' reserves are held in gold bullion. I have another slide that's actually not in this deck, but it just shows you who's been buying gold bullion. These countries haven't sold any gold for a number of years, but they're certainly not adding to their holdings. Meanwhile, places like Korea and Mexico and the Philippines, Thailand, India, China, I mean, the list of emerging economies that are voraciously buying gold. You know, the top producer of gold in the world now is China. They don't export a single ounce of gold. Russia, similarly the second biggest producer, they don't export a single ounce of gold. And the Russian central bank very kindly announce every month on their website how much gold they bought, and they are buying gold every single month. So gold as an investment, and we can get into that in the Q&A, should be a very important part of people's portfolios, and not from an emotional standpoint where people kind of find gold this lightning rod for everything that's good and bad in the world, and you get into some very heated debates about whether it's a good thing or a bad thing. As a means of storing some of your wealth, you can put it in the bank, in paper money, electronic money, and earn zero, or you can have a physical piece of metal that has always been wealth for 6,000 years. It won't pay you any interest either, but it's money good wherever you want to take it, whenever you want to take it there. And this is essentially the corner that the central banks have backed themselves into. And this vicious circle is going to continue until something breaks out somewhere. We've had the fear stage, so what do the central banks do? They buy a whole bunch of bonds. When they do that with the express intention of lowering yields and bringing down borrowing costs to try and stimulate the economy. When that happens, and we're in this phase now, you can see my little "you are here" sign there, confidence returns. Now, there's two kinds of confidence. There's confidence that the central banks and the government have, and they try and instill in us, and there's the kind of confidence we have in that we really do want to take our money out of the bank and invest it. And I don't think we're quite there yet. The problem is when enough people start listening to the governments and the central banks and really genuinely start to believe that things are okay again, the first casualty of that is going to be bonds. Because why would you hold a US government bond paying you 6 basis points for a 2-year treasury if you think everything's okay and the economy's going to grow? So those bonds will be sold. Once the bonds get sold, the yields start to rise again and the fear returns. And this is a vicious circle. I don't know which part of this breaks, but at some point it's going to have to break because this can't go around forever. Dave touched on Europe. Now I took this from another presentation I did, and in that presentation it scrolls, and it scrolls on forever, believe me. These are the comments from various heads of state, various finance ministers around Europe, going back to December 2009, when Brian Lenihan, God rest his soul, the Irish Minister of Finance, said that the plan is working, we've turned the corner. So that was pushing 4 years ago now, and they've been turning the corner ever since. It must be a pretty big corner. But as you can see, this is right across. This is right across Europe, and this is, in text form, this is the attempts to try and instill confidence. And here's the next one, still turning the corner. We're into March 2012 now. It's the same. We've turned a corner, the crisis is over. There never was a crisis in the first place, obviously, but had there been, it's over. We're stabilising. Slide 3, we're almost there, January 2013 now. And this actually, if you look in detail at these slides, it goes through several presidents in several different countries. So it's a long process. But are we almost there? No, we're really not. Europe is going to flare up again at some point this year, believe me. Dave mentioned the Spanish unemployment situation, and this slide touches on that. The Great Depression is this great epic disaster that everybody references whenever they want to talk about how bad things could get. How bad could things get? We don't want. We'll do anything we can to avoid another Great Depression. Well, this is the Great Depression. That red line there you see is US unemployment through the Great Depression. As you can see, it peaked slightly above 20%. So currently in Europe, we have 2 countries. Greece, which everybody kind of is a little bit over by now. It's not that big a country, and we keep getting told it doesn't matter. They're at 26.7% and climbing. More importantly, we've got Spain, which is the 4th biggest country in the Eurozone, and therefore the 4th biggest contributor to all the bailout packages. It's the 12th largest economy in the world. Their unemployment is currently 27% and climbing, both way worse than the Great Depression, and yet we're being told that it's fine. It's not fine. It hasn't been fine for a long time. It's not going to be fine for some time to come. Incidentally, in those 2 countries, youth unemployment amongst under 25s is 56%. And when you have 1 in 2 guys and girls under 25 unemployed and you go into the heat of a Mediterranean summer, trouble is going to happen. I can guarantee you that. At some point there are going to be more protests in Athens, more protests in Madrid, and it's going to start getting out of hand because very kindly the Spanish government have thrown to the press a very nice little bribery and corruption scandal that goes right the way up to Prime Minister Mariano Rajoy and may actually mean that he has to step down. I know, Spanish politicians, corruption, who'd have thunk it, eh? So we'll see, but there are plenty of things that will conspire to bring Europe back to the front pages, and when that happens, we saw last year, as Europe goes, so goes the rest of the world. So that's really the quick and dirty that I had for you in terms of slides, but I'm sure we're going to sit up here, and I'm very, very happy to take any questions you might have about any number of topics. So thank you very much for listening.